Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. I'm really excited to be joined by Greg Kuhl and Danny Greenberger, the REIT portfolio managers from Janus Henderson. You'll note that I do have a little presentation here up on the screen. We'll hop through a couple of slides real quick, compliance, disclaimers, disclosures, and then there is some slides that will turn back on the screen as we're going through the conversation. But this is expected to be more of a back and forth dialogue, looking at the current state of REITs, and more importantly, where are REITs headed in 2026? Um, and this conversation is very timely as we've had headlines today like Alexandria cutting its dividend on Investor Day, NAREIT here in Dallas next week with a lot of good commentary, hopefully coming from the REITs looking ahead to next year. So we're excited to be joined by the team for compliance purposes. This is the Janus Real Estate disclaimer disclosure. We will keep this up here just for a couple of seconds. And then I believe this is the Janus/Janus ETF disclosures page. So we'll keep this up for compliance purposes. For those that don't know, Janus manages over 480 billion with a B. This team manages 3 billion as part of a global strategy, teams in Chicago, London, and Singapore. I believe I'm speaking to both of my friends here in Chicago today. But hey, when you guys are looking for somebody to tag along to Singapore, on a road show, you got my number. A little background on both. I go way back in the day with both of these guys. Uh, Greg, PM, he was at Brookfield for many years. That's where I think you and I connected so long ago as a Brookfield, as a CFA. Danny, we were talking about our days going back to GEM. Shout out to our friend Liz Keeger if she's watching this right now. But Danny's been very active. He's also in conversation yesterday. I found out he's on the Real Estate Investment Advisory Council for NAREIT. So a well-respected leader and voice of the REIT industry. So let's take the slide off for a second here, and we'll come back to it. Danny, Greg, thanks so much for joining me. I really do appreciate it.
Thanks for having us. Great to talk with you, and we have a lot of respect and admiration for what you're doing here. I think it's great. So thanks for having us.
Appreciate it, Dave.
Thank you. Thank you. Well, let's jump right into it. What can you tell us about REITs in your view? What did you guys think about REITs and real estate performance in the third quarter of 25 coming out of earnings season?
Yeah, so I'll talk about 3Q, and then Danny, you could jump into, I think, big picture. So we'll comment on U.S. REITs for this, which for 3Q we're up about 5%, just start to finish during the quarter. Within that, you had by property type, which is something we look at. We track 17 different property types plus Canada. Very narrow leadership. So for 3Q, there was only 3 property types that really outperformed the bench in our view. So I'm talking, more than a couple hundred basis points, so 500 or more. Malls were the best performer during 3Q, then healthcare, and then diversified, which is really kind of a hodgepodge of different stuff. So narrow leadership during the quarter, and decent returns though. 5% for the asset class as a whole during the quarter is pretty good. If you look long term, REITs typically do upper single digit type of annual returns, so 5% in one quarter, pretty good. I think importantly, at least as we hear from our clients and others who might allocate to REITs, 10-year Treasury was down during the quarter. I think that was important for the asset class. We went from 4.5 to 4 during the quarter, which I think probably provided a little bit of a tailwind. Maybe I'll stop there. Dan, anything you want to add on 3Q? And we could talk post earnings too, which is into 4Q, obviously.
I would just add that there was some volatility with earnings, particularly from residential and storage. But when we rolled our earnings estimates forward through 26 and we're contemplating 27 as well, there were actually de minimis changes to our estimates in those sectors that were viewed a little bit more skeptically by the market through third quarter earnings. Just, I would say, modest negative revisions as we sort of rolled through, even though some of those sectors, Sunbelt and coastal apartments and storage, traded off and underperforming that 5%, bogey that Greg mentioned. So the places that people really sort of threw out with third quarter earnings, I think, we'll come to see actually have a fairly stable earnings roadmap as we get into 26, and estimates did not really come off all that materially, even though the stocks moved a little bit more negatively, through 3Q earnings there.
I want to come back to that, but you guys have this great slide that I have up on the screen here from your most recent letter talking about REIT earnings growth versus other sectors. And I was wondering if you could maybe touch upon your thoughts here as to why this stands out for you.
Yeah, I think this is so. I think maybe big picture when we think about where can we get returns from REITs, it's a couple of places that we think about. It is number one thing that we want to see the most confident area we have to source returns from would be dividend yield, right? We know the dividends for REITs are covered, so we can count on that for most REITs, other than ones like you mentioned ARE at the start, which cut their dividend. I mean, we could see that coming, but by and large, all REITs cover their dividends very well. So we know what that number is. We feel great about that. Earnings growth is kind of the other thing that we'd like to bank on, right? So dividend yield plus earnings growth, we feel great about. Those things we have a lot of confidence in. This slide talks about the thing of part of returns that we, by definition, have to have a little bit less confidence in, which is changes in the earnings multiple. So I think the point of this, as we look at it, is to say a couple of things. So number one, if you look at the left-hand part of the slide, we're looking at the change in earnings multiple across all of the sectors of the equity market since the Fed started hiking, which, as you know, is a big deal for our sector. So since the end of 2021, REITs have derated more than any other equity sector, which is because of a couple of things, but you can see at the top, REIT earnings are up by 20% since that time frame, but the stocks are actually down. So the PEs have derated by 30% more than any other sector that you can see there. That's just since the Fed cycle. On the right-hand side, you see a little bit of a longer-term view. So here we're looking at real estate PEs versus the S&P 500 PE. And what you see there is even more interesting potentially to us, which is you've got REITs trading just about as cheap as they ever have in this century versus the S&P 500. All of this, bringing this back to our sources of return, we don't know what's going to happen with multiples. Like, we think we know what's going to happen with earnings, and we really think we know what's going to happen with the dividend. But it feels awfully good for us. If you look on this slide at the right-hand side, multiple re-rating, it feels good to be at the cheapest valuation we've been at in 20 years. If we're sitting at the opposite side of that, if that chart was turned upside down and we were as expensive as we had been in the last 20 years, it would be a lot harder to say, look, we have a tremendously good outlook for REITs from here, because that's a tough starting point. We don't have that. We're at a really good starting point from a valuation. And these are real numbers on the slide here. So 4% dividend yield is current, and 6% growth is the consensus estimate for 2026. So that 6 plus 4, 10%, we call it, fundamental return. That is a real number. And combined with a really cheap multiple, we think that provides a really, really nice starting point for the asset class.
So you brought up some great points here, because we like talking about, I mentioned on Bloomberg a couple of weeks ago that coming out of that Fed rate hike cycling in March of 22, REITs have underperformed the S&P by like 70%. And as you mentioned, the fundamentals are strong, and a lot of folks outside the industry still look at REITs as if we're still stuck in COVID. And what I think, from where, we've all been around for a couple of days now, if you put back on pre-COVID glasses, If you guys recall, REITs were kicking butt and taking names. Fundamentals were very sound. All the sectors were firing on all cylinders. Dividends were very strong. Then COVID hit and everything turned upside down. And now here we are 5 years later. The fundamentals and the numbers are blowing away what they were doing pre-COVID. The dividends overall haven't caught up to where they were pre-COVID yet. As I say, that's a lot due to conservative management, balance sheet management, companies changing their thoughts on how to allocate net income versus instead of let's just push it out, let's have an 80% payout ratio. Therefore, we're very well protected, and yet, as you've mentioned here, the stock prices haven't caught up. So I think it's very interesting to hear your guys' take on things that this could be that inflection point here where, frankly, the fundamentals are too good to pass up. And again, there's bad apples, bad seeds. Nobody is perfect. There's a couple of outliers. But for the majorly followed names, the mid cap names, some of the strong small cap names, fundamentals are very sound. All right, so let's take this off here. All right, so you talked about in your notes about performance. You just mentioned malls, and I wanted to touch on malls, but also such as I think home builders. So what are you seeing in some of these other sectors that are out there that may be missed by the average investor or advisor?
Yeah, I can start with home builders there and maybe talk about the CRE brokers. We have a position in CBRE as well, and then maybe Greg can touch on malls. We own Macerich there in that space. In home builders, we think that they're doing a great job of meeting the affordability challenges facing the U.S. consumer. This has obviously been well publicized. If you look at various income to price metrics, home affordability is stretched by a lot of different metrics. But we think that the home builders have done an awesome job meeting the affordability, I guess, challenges of where the consumer is today. So we have a position in DR Horton. I think what might be underappreciated about Horton and its peers, it's a large cap builder. There's hardly any leverage left on the balance sheets of these companies. So net debt is very conservatively managed. These are free cash flow generative machines, and they take all that free cash flow and they return it back to shareholders in the forms of dividends and share repurchases. So they're really shrinking the share counts over time. So you do get that current distribution in the form of dividends and buybacks, while these companies are providing incentives and working with their suppliers to meet the affordability challenges of the American consumer. So Horton's delivering homes at about $370,000 per home. They've done a lot of more work than the existing home market has in terms of reducing price to deliver a more economical product for buyers, and it's resonating. Sales pace has actually stabilized here over the past few months, and we think that prospects for sort of further market share gains and volume growth and margin expansion could be on the horizon as we look forward to 26 and 27. So great balance sheets, and we think that there's a possibility for order inflection as we might get lower rates moving into 26.
Greg, before you chime in on malls, I want to come back to Danny real quick because I think one of the most unique stories, at least for us where we sit, and I don't know if you own Lamar and Millrose, but what's happened with Millrose over the past year, because that's like, what do you call it, a spin-off IPO? I don't know what you necessarily call it, but the performance has been crazy, like good. I mean, it's had a very strong year. Very unique story. Is that something that you guys are following, the Millrose story?
Yeah, so we know Lennar and we know the Millrose team well, and took a look at the transaction when Millrose spun. We don't currently hold either of those securities, but we actually view that transaction as being a really interesting moment for the home building sector broadly, because this cements another large cap company spinning off their land from the land assets, which are held in Millrose now, from the home building operation, which is now again hardly any debt, highly free cash flow generative, and what we're going to see over time is the ROIC from Lennar and its large cap peers just I think are going to surprise people with how persistently elevated they remain, and this is going to allow very I think pretty compelling shareholder returns moving forward. So to see one of the large cap builders again separate their land from the home building operation, I think it's very compelling and speaks to the industry structure just maturing and getting a lot more favorable over time.
Do you think we could see like Toll or somebody else doing the same thing in 26?
I think all the companies are all thinking about it. They all want to become more NVR like, land light, high returns on capital, higher shareholder returns. Toll Brothers recently sold multifamily developments that they had on balance sheet. It was about $400 million transaction. So furthering the process of moving away from sort of an asset heavy approach into one more of like an efficient manufacturing machine that can generate those high returns to enable faster growth and more distributions in the form of buybacks over time. So I think
Interesting.
all of the companies that haven't officially adopted this approach are going down that path.
Interesting. So, Greg, I want to come back to you because you mentioned malls real quick. And I spoke to our mutual friend, Michael Billerman, last week. I was talking to Stephen Yaloff about some different stuff, actually. Stephen's on the TV, it seems, every single day. You're going to see him on CNBC or Bloomberg talking about retail landlord strength and fundamentals. And I don't want to steal your thunder, but in talking to the team, what they've said is, look, David, we haven't seen any real retail development happen in the past few years. That means for every single day that passes, our existing real estate becomes that much more valuable. And we're signing new tenants with like double digit releasing spreads. It seems like, again, that's Tanger, a much different situation than, let's say, Assignment, or you mentioned Macerich, which for those that are watching this, great interview with CEO Jackson Say in Commercial Observer published yesterday. I don't know if you guys got a chance to see that. But very interesting turnaround situation. So, Greg, what do you want to tell us about the world of malls?
Yeah, I'll probably keep it sort of big picture, but I think this is an asset type within REITs that, maybe to your point, is a little bit misunderstood. I think, I know you remember back there was what I'll call the death of malls trade, right? 2015 or so through COVID. And it was, we don't need malls anymore. They're obsolete. They're all closing. Um, that trade is long gone at this point. And to be fair, it wasn't for companies like Macerich and Simon and Tanger, that was never really applicable, right? These are really some of the best malls in the country and retail assets that all three of those companies own. And what you're seeing is really pretty good demand for space from retailers, to your point today. I think most retailers at this point have realized that the physical presence is beneficial in conjunction with a strong online presence, and you need to be in a physical store. And in most cases, if you're going to be a successful retailer, and you see that, to your point, in the occupancy and in the rents that are able to be gained in these assets. One thing I think people may not realize is that malls, which is it, to be fair, it's a small subset of companies at this point in the bench, only a few, which we named three companies really, but it's outperformed overall REITs in each of the last 5 years. So it's kind of the opposite of a dying asset class at this point. Some of that is recovery from all that drawdown that it had in the years prior, but equally, the underlying business is good. And I think that's where, with Macerich, it's interesting to have sort of a turnaround story from more of a balance sheet perspective against that backdrop of the actual business is good to improving.
And there was also, again, the story in today's Wall Street Journal talking about how active the retailers have been leasing and their outlook for next year. Now, granted, we're not going to be seeing a Tractor Supply in one of the malls anytime soon. That'd be pretty sweet, actually. But we are seeing this uptick, and it seems like there is enough data out there that supports that. All right, so we've touched upon a couple of names. Are there any other, again, we're not saying buy, sell, hold, but are there any other, like another name or two that jumped out that you guys are watching or that you care to talk about right now?
I'll throw one out. So look, we hold 22 stocks in our ETF that we run in the US. It's hard to pick your favorite child.
First ETF plug. There it is. Okay, go ahead.
Yeah, I had to do it. So I'm going to throw out it's another retail idea, but a little bit different. So in NetStreet, I know you know these guys. This is a
My backyard.
exactly, yes, single tenant net lease landlord based in Dallas. And so their business is like if I think about their biggest tenants, it's grocery stores, convenience stores, home improvement, Walmart, tenants like that, right? So they are one tenant in a single asset. They have super long-term leases, very good quality tenants, and low risk. So and sometimes we call it the most boring business in real estate, but it still benefits from all these trends that are positive for retail in general right now. And this is a business where it's about acquisitions and buying more of these things. So NetStreet today has a really good cost of capital. They're able to go out and buy more of these convenience stores, quick service restaurants, et cetera, in a way that's accretive to earnings, which we really like. At the same time, they have a great balance sheet, which is not stretched at all. They're paying a dividend that's close to 5%. And if you look at what they could grow earnings at in 2026, we think it's probably north of 6%. So going back to my math earlier, we like the control your own destiny part of the returns, which is dividend yield plus growth. That's 11% for NetStreet. It's a really good starting point for that. And we think that the actual valuation, the earnings multiple is pretty cheap and a low risk business.
So follow-up question. I wouldn't say, okay, why that versus ADC or Agree or Realty Income? Because again, I think size matters, so that's a whole different story. But why NetStreet versus somebody like Essential Properties or somebody else that might be in that same, call it size or end of the pool as they are in? And I'm not saying why hypothetical buy NetStreet, sell everybody else, but why NetStreet versus let's say somebody closer in size like an ePert or somebody like that?
Yeah, I think, and look, I mean, EPRT is also great at what they do, right? So there's just a different focus that they have, and I'm not saying I don't like EPRT. That they're a great read also. They have from a tenant credit perspective, they play in a different sandbox. So
Okay.
if you think about NetStreet, you could think about them as like an investment grade bond from a tenant perspective, and if you think about something like EPRT, it's more of a sub-investment grade. So their pitch would be we can underwrite the credit of tenants that are maybe too small to have a rating, like middle market type of retail tenants, and they get a premium for that. So they get higher yields on the assets that they buy because they're taking a little bit more risk technically on the tenancy. But if you look back at their history, they don't have a lot of credit loss. So they have done a really good job in terms of underwriting the risk and getting paid for it.
Mr. Mannheimer just texted me and said, thanks for the shout out. I'd appreciate it. Danny, what about you? You got one for me?
I'm going to give you another non-REIT that's also sort of, firmly linked to the, real estate income producing asset class, and that's CBRE. So we consider this a broker. We call it CRE Services.
Another
This,
Dallas company for the record, by the way.
yeah, it's one of the best. They have unmatched scale within brokerage and real estate management services. I think the reason we're really excited about this one is you're getting a cyclical and secular sort of growth story from this entity. So the cyclical recovery is coming from their transactions lines of business where they have basically the top brokerage teams in most tier one and tier two markets around the country, and in many global markets as well. Um, Transactions only started to recover on a year-over-year basis 5 quarters ago. So you basically had a halt in all transaction activity of size when interest rates spiked in the second half of 2022. Um, you're only now starting to recover in transactions. So we think there's a long runway ahead of recovery in brokerage activity as the asset class gets re-equitized, new entrants come back or form and come back. In some key verticals like office, you're running well below half of normalized transaction levels. So we think there's just a lot of coiled spring that could sort of unlock there in the transaction lines of business. And then they've been taking their free cash flow and bulking up in what they call resilient lines of business that are more property management, facilities management oriented. They're getting them into a lot of technical work, engineering type of work that can help make buildings more efficient, more profitable for owners, et cetera. So just long runways of white space ahead, both from a cyclical and secular recovery there for CBRE. So that's one we're really excited about as well.
All right, so now let's take it a step backwards and let's go more sectorish focused. You guys have this great chart, Greg. You and I were talking about this one earlier, and you're looking out through 26 or into 26 as far as supply and completions. Walk us through this. What sectors are standing out to you guys right
Maybe I'll just give a quick overview and then Danny, you jump in because I think you're the expert in the sectors that really stand out. So the reason we care about this is we operate in a sort of a simple business, which is really supply and demand, right? And it's if you have more demand for space than supply of space, your buildings will be full and you'll be able to push rents. And that's what you want to be able to do as an investor, to be able to invest in that. So demand can be tough to forecast, right? There's things that happen in the macro that can impact demand for different types of real estate, things that nobody could expect that we can't forecast. What we can see really clearly is supply because depending on the type of building we're talking about, these take between 1 and 3 years to build. So you have a really good idea of where is their shovels in the ground, where are their buildings coming out of the ground, and what are they. So that is a known and it's a super important input into what the prospects are for a particular property type. And maybe Danny, you could talk about a couple that really stand out here.
Yeah, if you look at the right-hand side of each subsector here, in the lightish blue bars, we see the most steep declines coming from apartments, industrial, and self-storage as we move from 25 to 26. So just to comment, on apartments and storage. In apartments, we're coming off a 50-year record, peak in new construction that occurred basically because of unbelievable, um, fundamentals that, early on in the reopening, call it 21 and 22. Access to capital was plentiful and developers putting shovels in the ground to try and take advantage of those, amazing fundamentals that we saw several years ago. We're coming off of this. So supply deliveries are going to be, forecasted to just be over 1%, as a percentage of inventory for apartments in 26. And I think the reason this gets us excited is because even getting hit with a 50-year supply deluge, the asset class, particularly in the Sun Belt, where we've seen most of the supply, is basically not even going to have negative NOI. So if you look even at the most dire forecast for NOI growth, maybe your most shallow point, you were -1%. I mean, I think it speaks to the operating acumen of the public REITs within the space and their ability to navigate a high supply environment and the durability of demand that we're seeing even in the face of all that supply that we've absorbed over the past few years. So I think really constructive about the supply picture. People are concerned at the moment about how strong demand might be, but overall, I think there's like a very accommodating supply backdrop, and then the same could be said for supply in the storage space as well. If you talk to a company like PSA, their management team will tell you they're already seeing, selective instances of more pricing power because of the way supply is coming off, across their sector. And again, they had a lot of supply deliveries, even dating back to the pre-COVID era in 17 through 19. So I think what that chart and that illustration portends is a resurgence of pricing power across a variety of different sectors. We're obviously seeing it in senior housing, where there's been hardly any supply that's up, been able to keep up with the 80 plus demographic, which continues to grow very quickly. But I think if we're able to look out, maybe beyond the next quarter or two, you could start to see a widening out of pricing power across, a variety of different subsectors. So yes, it's most pronounced right now in senior housing, but would it surprise us if you started to get more pricing power in places like residential, storage, industrial? I think it's all looking in that direction, so long as the economy holds up.
So, sector-ish, high-level type stuff again. What about like employment growth? What sectors do you think, again, if we do see, we got boatload of payrolls data coming out in the next week to whatever, like there's a lot of data that's coming out. If we do see payroll start to go positive, how do REITs benefit? And by the way, let's take a second part to that to try it for time purposes. Lot of chatter about tariffs, but we haven't seen it really at the REIT property level yet, impacting the landlords. So, thoughts about employment growth that may benefit the REITs, and then tariffs and the impact that it could have on both the domestic and global side. Whoever wants to cover that.
Maybe I'll start with the tariff part, Danny, and then you could talk on the jobs part. Um, so tariffs, it's tough to say. It feels strange to say to say it's a positive for real estate, but if you think about the different ways it can impact real estate, one big one is the cost of materials that go into buildings. And this is going back sort of to the supply conversation we just had. But if you're a developer and you're building any type of real estate, you've got, an expected return that you're trying to hit, right? So you're looking at, okay, what is the cost of land? What is the cost of all the materials that go into the building? How much does it cost me to fit out the building? And then you look at that and you say, okay, I want to make a return of whatever it is, 12, 13% unlevered. So what do I have to charge in rent then to be able to do that, right? And so the more your cost of building goes up, the more you have to charge in rent to justify your investment to even do the project. And if you're an incumbent owner of real estate, like the companies, the REITs we're investing in, that math gets harder, right? Cost of building materials goes up because of tariffs. The rents that you must charge go up, which makes you less competitive with existing real estate who don't face that issue. So I think on net, in our view, so far, it's a positive from that perspective. The initial concern back in April was this is going to tank the economy and cause lots of inflation and all of those things, and that would be bad not only for REITs but obviously just for the markets in general. That kind of hasn't played out. I think we've seen it come in much better than feared, at least so far on those fronts. So I would say at this point, it's a probably small net positive for the asset class on the tariffs.
On the job front, I can think of a couple sectors. One would be residential and apartments in particular. There is an element of cyclicality in these businesses while it is needs based and non-discretionary. If there's a firming of the job market, and I think it's important to point out too that even though job growth has slowed since May, wage growth has been quite impressive. So even this morning with the ADP jobs number, we saw wage growth for non-movers. So those not changing jobs was up 4.4%, well outpacing the the rate of inflation and rental rate growth. So the affordability calculus for apartments is getting more favorable what seems like every month. So ultimately, you're going to have more pricing power that surfaces to landlords. So I think that's one area where you're going to see better leasing, and we had a bit more of a shallow leasing season this year. It wasn't as firm as the management teams thought it might be in the face of that softening job market, but I think that could reverse very quickly. And we'll get early signs of that over the next few months here. The other place is candidly retail. I would expect, particularly if there's more certainty around tariffs, that store opening plans might firm as well. They're already in a pretty good spot from an occupancy perspective. Those REITs have, been slight laggards on the year, but could we see that performance turn around in 26 on, further clarity on tariffs and then a better jobs picture? I think that could be possible as well.
So, Greg, you spent some time walking us through this slide here, your 6 and 4 in growth. But now I want to fast forward to ask that question of how do you guys do it? What is the sweet sauce for Janus when you guys are out there doing your real estate investing? I know that was one part of it, but you have this, again, a great slide in your presentation here where we, again, look at earnings growth, long-term returns, all that stuff. And I'm sure some of this plays into your thesis. The good old volatility equals opportunity conversation. So maybe can you walk us through some of the Janus sweet sauce and how you guys make it work?
Yeah. So I think that, good setup there in terms of this slide, right? It's good to know what we're playing for, right? So long-term returns, we've got going back 25 years here, 10% for REITs, which just from an absolute perspective is, I think, a really good number, but also something for us to use as somewhat of a bogey in terms of, hey, well, do we think that XYZ stock can return more than this over the next year or two? Because that's kind of what we expect from the index. Um, the earnings volatility point is on the left. So you see REITs don't have a ton of earnings volatility, is kind of the point there, which you would expect because this is a business that operates on contractual leases versus, the S&P 500. How many widgets am I going to sell next year? Like nobody knows, right? But I know that I have a lease with Janus Henderson and they're probably going to pay the rent. So that hopefully, so that's the starting point. In terms of how we do it, I mean, we've got, thankfully a lot of experience kind of covering these companies. We analyze them bottom up, and all of that. And we're looking for a couple of things. I think we sort of touched on it with the earlier slide. Number one, we want stocks and companies that can control their own destiny through returning capital to shareholders and growing earnings. That's a big part of what we kind of must see because I think we all know the market is not necessarily that reliable at pricing things appropriately from an earnings multiple perspective in the short term. In the long term, we think it is. And so that's where we want to see for sure a big component of our expected return that we calculate for all these companies coming from things that are in the control of the company. And then if we say, look, okay, we think that dividend yield plus growth for XYZ REIT looks really solid, maybe those two combined are north of 10%. And also we think that the stock is really cheap on a, PE multiple or implied cap rate. So meaning, the capital value is just lower than it should be, or that, one benefit of real estate is we can track public and private markets, right? So 90% of CRE is privately owned. Danny talked about CBRE earlier, who's a brokerage firm. They publish data, and we talk to brokers that are there and other places about trades that happen in the private market. So if I can see that an apartment REIT or apartment building in Dallas is going to trade for a 5.5% cap rate, and I can see that high quality REITs who own apartments in Dallas are trading at a 7% implied cap rate, that's a big disconnect, right? So that's something that we look for too. We want to have ideally all of those things line up to where we've got the in your control type of growth plus yield, and we think that there is going to be upside from a capital value perspective.
All right, so then let's fast forward. What is the value proposition for REITs in 26? With all the stuff that you're saying here, what should we be looking at for 2026? Danny.
Yes.
I will just go back to sort of a comment that I made earlier with regards to the supply picture coming off. I think that the things that can derail a real estate cycle are disruptions in the capital markets when i.e. when the lending picture freezes or gets more fraught, or when you outrun demand with too robust of a supply picture. When we look at the credit markets, they are buoyant. You know, um, Access to capital is plentiful for our companies that need it. Our asset class has massively delevered over, really since the GFC. I think it's underappreciated, the strength of the balance sheets across REIT land. Very low levels of debt to EBITDA or debt to assets, in a very accommodative capital markets backdrop. And then layer onto that, the supply picture is going to just get a lot less competitive across areas that have, been digesting supply over the past few years. And I think all this adds up to, an environment that, the asset class is going to be able to deliver upon sort of that rubric of mid-single digit earnings growth. That's a building block of that, call it high single digit, low double digit total return into 26. So I think, in short, it wouldn't surprise us if we start to see, gradual recovery in some of these spaces where pricing power has been a little bit soft over the past couple of years. Could it start to firm as you get out, 2, 3, 4 quarters? And then people are going to be looking into a multi-year recovery in an acceleration in pricing power, perhaps that could be very promising for the asset class. So I think it's just, knowing what the business is capable of from an earnings perspective. I think mid-single digit growth is possible. We haven't talked about rate cuts, but I think that's also possible in terms of engendering more capital flows into the industry, which could unlock some capital recycling opportunities for the REITs, could allow them to, issue equity at accretive prices to go do interesting deals, as the asset class sort of reliquefies from where it's been over the past couple of years or continues to, because that process has already begun. So I think mid-single digit earnings growth with some interesting kickers for growth, I think is what's in store for 26.
So as we come to the close here, I do want one more question. If anybody in the audience has a question, please put it in the chat. We'll try to get to it. But Janus, household name from where we've sat, talks to a variety of advisors, investors, everything across the spectrum. So whether somebody is young or old, if you could offer one piece of REIT investing advice to the viewer of this video, what would you say?
I'll throw one out, and Danny, you could do the same. Mine would be to own REITs. I think that on most, not maybe not most, but a meaningful percentage of prospects and people that we come across don't have a specific REIT allocation. And we showed earlier the long-term performance of the asset class. Now it's been weaker in recent years because of the Fed basically repricing our asset class for us. And relative to things like the Nasdaq, which have been on an absolute tear. But if you take a long-term view, nothing lasts forever. Markets are cyclical, and I think solid combination of income plus growth plus maybe some capital appreciation is really good for the long term. It may not be exciting every year, but I think most people are under allocated to this asset class. So my advice would be to own it.
Danny.
I'm going to echo Greg's comment. I'm going to just, my response to this question be avoid complexity wherever, you are in your investing. But so that means, stick to what stick to sort of, vanilla structures, things you can understand. And I think within that message, I think REITs sort of stand out within the broader real estate market. So, we're only 10% of the overall only 10% of the overall institutional grade real estate market. But REITs are sort of the OGs of core real estate, and the structure has been very compelling for investors over time. Um, and that's because we have low leverage, transparency, management teams, some very high quality management teams and operating capabilities. So if you're going to put a dollar into real estate, it might as well be in the asset class that offers you know, a simple business model that is capable of compounding capital for you and delivering a nice return over time. And it's through that simplicity, high quality management and low leverage that allows the asset class to do that.
Well, Greg, Danny, thank you so much for sharing your thoughts and wisdom with us. I hope we're able to sit here December 3rd, 2026, redo this whole thing again and see, did everything play out the way that we hoped it would? More importantly, what does this mean in 27 and beyond? So, Greg, Danny, thank you so much. Greg, I look forward to seeing you here next week in Dallas for the big NAREIT conference. Danny, I will see you in June at NAREIT, hopefully. And more importantly, have a safe and happy holiday, healthy season.
Thank you. You too.
Thank
It's
you
our
so much.
pleasure. Appreciate it.
Thank you so much.